Welcome, my friends. My name is Riley Hale. I'm a financial planner that specializes in equity compensation. Today I'm going to be discussing the 3 different ways that you can exercise your stock options, whether that's incentive stock or non-qualified stock. The same rules generally apply for the most part. So let's go ahead and start by imagining with me a continuum or a risk spectrum. And that's what we're going to call it. And on one side you have somebody that's able to take on a lot of risk. And on the other side, or the other extreme, you have somebody that's not able to take a lot of risk. Now, on the spectrum, I'm going to place the 3 different ways that you can exercise. But before I get to that, I need to ensure that you understand that this is general information. It is not intended to be specific or individualized tax, legal, or investment advice. So please work with your professional. So on the far side of the spectrum, we've got somebody that's able to take on a lot of risk, both emotionally and financially. And those are important, and the exact terms is, or the exact terms are risk tolerance and risk capacity. Risk tolerance is alluding to one's emotional ability to take on risk. So are they sleeping well at night, or are they always in a cold sweat worrying about their investment or losing their investment? So again, that's risk tolerance. And then risk capacity has to deal with somebody's financial statements and their financial ability to take on risk. So for me as a financial planner to look at somebody's financial statements, I'm looking at their assets, their liabilities, their cash flow. What does that say about their ability to take on risk? And so both of those things should be taken into consideration for the first way to exercise, which is exercise and hold. Now, this is a great option, again, for those who have risk tolerance and risk capacity to take on risk. So those that have a very high net worth and diversified portfolio and lots of cash flow, this is a great option for people like that. But again, just a friendly reminder, your specific situation, I may suggest something other than this. So please don't take this as individual advice. But somebody that, again, can take on a lot of risk, exercise and hold could be a great option for them. And especially if one has incentive stock options, or ESPPs, standing for Employee Stock Purchase Plans. If you have that, exercising and holding is a great option because you get a tax benefit for doing so. Now, that's the first way to exercise, and I just want to review quickly the life cycle of a stock option. So a stock option starts out as a contract. It's an option. It's a contractual right for you to purchase a share at a pre-specified price. That's a stock option. When you exercise it, you're buying shares of your company. And then when you sell those shares, you end with cash. So again, life cycle wise, you start with a contract, you then move to shares, and then you move to cash. So that's the life cycle. So when we look at the very first way to exercise, which again is exercise and hold, the life cycle there is you exercise your contractual right, you purchase the shares, and you hold on to those shares and you sit on those shares for at least a year so you can get the best tax rate. And there's even more tax advantages to that beyond just the long-term capital gains tax rate. But that is the main gist of the life cycle. You, again, are exercising, and then you receive shares, and then you hold on to those shares for at least a year, and then you sell them whenever it's convenient. There's a lot of tax considerations that go into when to sell and even when to exercise. So let's go ahead and hop over to the far other side of the spectrum. So again, exercise and hold, that's on one side of the spectrum, somebody that's emotionally and financially able to take on a lot of risk, and they have incentive stock options, which the exercise and hold is a great strategy for. Let's go to the other side of the spectrum for somebody that doesn't have a lot of risk tolerance or a lot of risk capacity. Their net worth is low, they're just getting started, they have a lower income, they can't necessarily afford to invest money in their company for the long term. So this way of exercising, there's 3 different ways to do this, and I'm just going to say that they're all synonymous for the purpose of this video, but there's some slight nuanced differences there. But the three different ways of doing or exercising your stock options on this side of the spectrum is known as exercise and sell, a same-day sale, or a cashless exercise. Again, we're going to treat those as synonymous for the purposes of this video. But if we look at the life cycle of somebody on this side of the spectrum who is doesn't have a lot of risk, can't afford to take on a lot of risk emotionally, financially, and if we look at that, look at the life cycle, recognize how fast things happen, because you start with a stock option, and then you move to shares, and then you move to cash. And what happens when you're on this side of the spectrum is that all of that life cycle, all of those steps happen all simultaneously, like in an instant. So a lot of times you don't even need to pay to exercise. Sometimes they'll just give you the shares, exercise and sell the shares, and then give you the cash to fund the rest of the exercise costs and tax withholding. So again, all of that is happening within a split second. And the reason why this is great for somebody that doesn't have a lot of risk tolerance or capacity is because they might not even need to use money up front to pay for the shares or purchase the shares, and they're not really subjecting their cash or their money to the long-term ebb and flow of a company, because they have a contractual right, they know what the stock price is, and they do an exercise and sell all simultaneously in one split second. And so you're not really, again, subjecting your assets to the stock price for the long term. So there's not a lot of risk in that option. And when it comes to having different kinds of equity, whether it's incentive stock options or non-qualified stock options, typically, depending on your situation, again, this isn't supposed to be investment advice that you act on, there are opportunities to exercise and hold for your incentive stock options because you get a tax benefit for holding. Whereas if you're going to do cashless exercise, it might be a good idea for your non-qualified stock options or RSUs, which technically aren't stock options, but they're taxed similarly to your non-qualified stock options. So as soon as you receive the shares over here and you sell them immediately, they're going to be taxed at ordinary income tax rates and subject to FICA tax. So that's why you would use non-qualified stock options, is because oftentimes it's not necessarily worth holding those shares for the long term, because you don't have the tax advantages or benefits as you do as incentive stock options. So you don't necessarily want to hold, but rather you want to use those shares to diversify out of your single company stock withholding or your stock holding, and you want to diversify out of that. So again, that's just some general planning strategies, not fit for everyone, but for some people it makes sense. Now, we've addressed the two ways that you can exercise your stock options. One is exercise and hold. The second is on the far other side of the spectrum. It's almost the exact opposite, is exercise and sell, same-day sale, or cashless exercise. Now, there's a way to get the best of both worlds to a certain extent. And this last way to exercise is right in between and right in the middle of these two extremes. And this is called sell to cover. And what you're doing is, with a portion of the shares, you're kind of doing a same-day sale or a cashless exercise to create liquidity. So you're selling some shares in order to create some cash for yourself, and then you use that cash to exercise the remaining shares, and then you hold on to those remaining shares. So again, you do a cashless exercise of sorts to pay for taxes and exercising costs and other fees, and then you hold the rest. So you get some of the upside of holding onto your company's stock, assuming the stock price continues to rise, but you also avoid some of the downside if the stock price drops, because you've liquidated some of those shares and you may have liquidated some extra cash that you could then go and diversify with into a different portfolio. So those are the 3 different ways to exercise. Again, just a quick recap: exercise and hold, a cashless exercise, same day sale, or exercise and sell. And then lastly is a sell to cover. If you have any further questions on your specific financial situation or anything regarding your company equity, you can schedule an appointment with myself in the description down below. I've set a link there. And then lastly, if you're wanting to know when to exercise, I've made a video that helps you consider the different things that you should be considering when exercising your stock options. So please watch that video here, and hopefully it gives you a better idea of when one could consider exercising. Thanks.